These updates are current as of June 2023 and include changes since our similar tax update course released the same time last year. The purpose of this course is to bring you up to date on the 2023 facts and legislative changes that affect your clients, explain the key changes related to the Inflation Reduction Act and Secure Act 2.0, provide you with the 2023 tax rate and other changes to amounts and deductions, highlight details and developments that will be useful to you in your tax practice.
I think I'll sit here. I'm gonna sit here.
Okay.
Kristen, I'm gonna get chair for Kristen.
Oh, you gotta keep punching this thing.
Hello, this is Ben Tallman, and I want to welcome you back to the Drake CPE section here. We're going to talk about 2023 and the new tax updates. I hope you're sitting down and you're ready with a cup of coffee or whatever your preferred beverage is. And we got some good information going on here today. We not only have a lot of the rules from 2022 that are taking effect this year, but also we have the Secure Act 2.0. And that one has a lot of additional information. Not all of it has to do with retirement. So you want to pay attention when we get into that. This is going to be an exciting session today. And I hope that you're ready to go. So with that being said, again, my name is Ben Tallman. So let's look at our learning objectives today. We're going to get into the Inflation Reduction Act as it applies to the 2023 changes. Now remember, this act came into play last year in 2022, but had very few things that activated. We're going to talk about all the activation items in this law as we go through the material today. Also, we have the update on all the things that are changing for 2023. We've lost a few things this year. We've gained a lot of things this year. So let's be ready to highlight some of the issues and make sure that we're picking up on all the new information that's going to impact our clients for next tax season. Then, as you've seen in the past, if you've been in one of these sessions with me, I always give you a comparison table showing the new 2023 tax rate and as a comparison, right below it, the 2022 tax rate table. So if your client comes in and says, hey, what's changed? What tax bracket am I in this year? Please feel free to make a copy of this, keep it at your desk, share it with others in your office, and use this as you find appropriate to help you in keeping your clients updated. I've tried to highlight a lot of the useful tax information and material, the facts that I think are going to be interesting to you. Some things that we talk about today, you've probably heard me talk about before if you've been in the session, but it's okay. It's always good to have a refresher. You never know when that client might come in your door that needs to write off something on a 2106. And if they meet this special test, then you want to have this fresh in your memory to say, oh yeah, we can't deduct that on Schedule A, but guess what? We can deduct that on the front of the 1040 as a 2106 item. Also, we'll get back into statutory employees. It's always good to have this information fresh. You never know when you're going to need to refer to it or use it. And then finally, we'll get into the Secure 2.0 Act. Again, as I said, this was passed in 2022, but almost all the changes become effective this year in 2023. So let's go back and look at the Inflation Reduction Act. What has changed? What items do we need to be familiar with? Well, we're back to the 30% energy credit on all of these basic items that we have grown accustomed to through the years. Wind energy, solar energy, geothermal energy, but they've added biomass, trash and landfill gases, qualified hydropower, and then marine and hydrokinetic sourced energy comes from the ocean. So they've added several new items that you just need to be aware of.
Yes.
And you not only get 30% or 30% credit on the specific equipment, it also now includes the installation cost. So you get 30% of what you spent in order to add one of these new energy savings items. Now, on top of that, Form 5695 has undergone some major changes for 2023. The biggest is if you go out for your home and buy a tankless boiler, or some people refer to those as tankless water heater, or a biomass stove, the credit can be up to $2,000 for one of those. Now, if it costs you $3,000 to put in a tankless water heater, 20%, well, excuse me, 30% of that is not quite 2,000. So, but you can see how if you're adding a biomass stove and a tankless boiler, you can take up to $2,000 off in actual credit. Now, what about the rest of the 5695? These are energy efficient home items. Could include something as simple as a home energy audit. If you have to pay $150 for a home energy audit, guess what? They're going to give you that back as a credit. Now, if you're putting in new energy efficient windows or doors, you see the window, the top cap on windows is 600. So if you spend $30,000 on new windows, you're only going to get $600 in credit. So be sure that people are aware of the fact that this has a cap to it. You're only going to get $600 back on energy efficient windows. Energy efficient doors, the max cap for the year is 500. And then you also have HVAC and insulation, but the maximum cap for all these things combined in a single year is $1,200. So if you're adding new windows and doors or new HVAC system, try this again, or a new HVAC system or insulation, be aware that there are caps of $1,200 a year. You might decide to spread this change or these improvements over multiple years. In that way, you could get $1,200 each year as you reach the caps. So it's a good thing. It's definitely better than the old 5695, which did this as an accumulated credit. It's now an annual credit. Each year is new unto itself. So each year you could get up to a maximum of $3,200 for your home energy items. Now that excludes the one on the top line here, which is, of course, as I said, 30% of the wind, solar, geothermal, biomass, trash and landfill gas, qualified hydropower, and marine and hydrokinetic energies. So those are separate. The top one has its own credit. The bottom two are limited to $1,200 and $2,000. So what else has changed? Well, if you have decided that you can't find good health care anywhere else, let's say your employer does not provide health care for you, you have a family, you need health care, and you go to the healthcare.gov website. Up to this point, if you exceeded the federal poverty guideline by over 400%, then you did not qualify for healthcare.gov and the coverage that they gave you. However, if your premium exceeds 9.12% of your AGI, then now you do qualify. So if your premiums are expensive, let's say you make, I'm just going to keep this easy, $100,000 a year, and you're spending over $9,120 for healthcare premiums for the year, then you would qualify to go through healthcare.gov on this example. So keep this in mind. It's a change that we haven't had before. It actually implemented itself last year, but we want to make sure you're involved with that this year, just in case you have someone that is paying so much for premiums, even through healthcare.gov, and it exceeds 9.12% of their AGI. Again, qualified small business can qualify for up to a $250,000 credit for research expenses. But here's the catch. You can only apply this credit against your Medicare payroll tax. That's all. So it's a very defined, narrow credit, can only be used for Medicare payroll tax. But it does carry over. All right, caps on an NOL. All right, if you have a taxpayer that's writing off an NOL, as you know, there is an 80% usage point that you have to run through a special worksheet that limits you to 80%. But if that 80% comes out to more than 578,000 for married filing jointly, or more than 289,000 for single or head of household, then there is a cap. It's going to stop you. And anything beyond that is part of your NOL carryover. So just be aware, these figures change annually.
Computer will do that.
And this year it's 578 for married filing joint, 289 for single or head of household. Inflation Reduction Act, we're still here. Again, if we see forgiven student loan debt, and right now we don't know what the status on that is, just be aware there are some guidelines that I've listed here. There's a few states that will actually tax that forgiveness. You see them right here: Indiana, Minnesota, Mississippi, and North Carolina. The rest of the states are going to let it ride. And it does double the amount that can be forgiven if you have a Pell Grant. Okay, now here's the one that everybody's been waiting for. The new 2023 EV and fuel cell credits, but there are restrictions. Now again, be paying attention because there's a lot of changes that are different from the old EV credit. Cars are still at $7,500, but the MSRP has a cap of $55,000. So if you're buying an EV car, then you're going to have to find one that sells for $55,000 or less. Yeah, I know that's going to be hard to do. However, if you're looking at vans, trucks, or SUVs, that MSRP goes up to $80,000 for the same $7,500 credit. So it almost appears that the EV credit is a little biased towards vans, trucks, and SUVs. All right, another condition here, or restriction, if you will. You've got to have final assembly for that vehicle in North America. Now you notice it doesn't say the US, it says North America. So what does that include? It includes Canada to our north and Mexico to our south. So if that final assembly took place in North America, you're going to be okay. Now, half of that 7,500 actually gets split in half. 3,750 applies to the critical minerals requirement. They haven't told us what the percentage It is the percentage to be extracted or processed in the US or someone we have a free trade pact with. Well, Ben, what does that mean? Well, what if we have a free trade pact with Bolivia and they're providing a lot of these minerals? Well, because we have a free trade pact with them, it counts as if that mineral was here in the US. So there are some catches that will help us out.
Law.
Now, the second half of this for the other 3750 is battery capacity. Must be at least 7 kilowatt hours that it runs. And in addition to this, there is a modified adjusted gross income limit of 300,000 for married filing joint, 225,000 for head of household, and 150,000 for all others, which is usually just single or married filing separate. So Ben, what does this mean? Well, if you make too much money, you're not going to qualify for the EV credit. So if you're bringing in $450,000 a year, married filing jointly, and you buy an EV, you're not going to qualify for the credit. Interesting facts here. Now, there's a new change coming in 2024. This will be next year. But if you qualify, you meet all the tests we just talked about on the previous screen, then you can now go to the broker where you're buying your new EV and you can ask the dealer to pull the credit off your sales price. Now, that doesn't happen until next year, till 2024, but you need this information to start sharing it with your clients. If you have clients that qualify for this credit, they need to know this is coming, it's on the horizon. If it comes up with the dealer and they want it to be taken immediately off the sales price, they can have the dealer take the EV credit and they get a reduction in their sales price by $7,500. Now, there is no production cap as of 2023. Remember, in the past, you had to be one of those special people that bought within the number of cars that would qualify for the credit. This is no longer the case. It's now a situation where there are unlimited numbers of vehicles that all qualify for the cap. All qualify for the credit. Also, what happens to the old or the used EV or fuel cell vehicles? Well, they've even got that covered. If you've got an EV or a fuel cell vehicle that's at least 2 years old, you can now qualify for a credit because you're the new owner on a used EV or fuel cell. The credit is limited to $4,000 or 30% of the purchase price. And just like with the previous new vehicles, the cap on the car, and we talked about this, car was $55,000 previously on a new vehicle. On a used vehicle, the cap is $25,000. So if you're buying an EV for anything more than $25,000, a used one, you don't qualify for the credit. Now, just like we mentioned earlier, the modified adjusted gross income limit is exactly half of what it was on the previous list. So you've got on a used car, if you're married filing joint, make over 150,000, you don't qualify for the credit. And you see the other two fall in line right behind that. So there are a lot of little tests and restrictions that you need to inform your client on, because if your client comes to you, Ben, you said I qualified for this credit, and if I haven't gone through this list with them, it could be a tough situation for me. Ben, you owe me $7,500. You told me I was going to get this credit. Be aware, you've got to take the time, especially if they contact you. Ben, I'm getting ready to buy a new EV. I want to know if I'm going to qualify. You need to pull out this list have it close by, have it close to your phone, have your people briefed on this, and make sure you go through all these little conditions. Because if they're not going to qualify, you need to tell them up front. Now, how about commercial vehicles? Well, guess what? They've got a $7,500 credit for that also.
Let's see how the
However,
average person
unlike
could jump on
cars,
hoops.
which have a 6,000 pound cap to them, commercial vehicles have a 14,000 pound cap to them. Now, if you have a vehicle heavier, commercial vehicle heavier than 14,000 pounds, that's heavier than 7 tons. Wow. Then you could qualify for up to a $40,000 credit for that commercial vehicle. I don't know where that line breaks. I'm not sure if that's talking about semis or other vehicles of that size, but you'd have to check into that and find out where that poundage is going to change. Now, the credit cannot exceed 30% of the MSRP. This would be for an EV commercial vehicle. What if you've got a hybrid? What if you've got one that runs on a fuel cell along with gasoline or diesel fuel? Well, the credit then drops in half to 15% of the MSRP. So even though we don't have an MSRP restriction here, we do have a poundage restriction on the vehicle, and we do have a maximum that you can receive. So beware, commercial vehicles qualify also, but they've got some fancy little tests. Also, 2023, we have a 15% alternative minimum tax that now applies. Now, this is a figure that's averaged over 3 years. If your average earnings on your financial statement, or let's just put income instead of earnings, could be the same thing, but we're using the word income here, are over $1 billion annually. And this would be an average over 3 years, 1 billion average over a 3-year period. Then you would be subject to the 15% alternative minimum tax on businesses. Now, there are 3 companies that are exempt from this. Subchapter S, a registered investment corporation, or a real estate investment trust are all exempt from this new AMT. In addition, if you're buying back stock, if your company's had a good year and you're buying back stock from the stockholders, then once you repurchase at least $1 million in stock, there will be a 1% excise tax assessed against your company. Now, this probably isn't going to affect anybody you or I know, but just so you know, you've heard it here. Okay, let's get into standard deductions. So they have gone up substantially this year. Be aware, singles now $13,850. Head of households over $20,000. Married filing joint over $27,000. Now, if you've got a couple over 65, that means $1,500 a piece. That means that your new standard deduction for seniors over 65 is now $30,700. I don't know about you, but I don't think I'm going to see a lot of seniors unless they're just extremely generous or have a lot of medical expense. We're probably not going to see too many seniors that qualify for itemized deductions. All right, kiddie returns. Again, if the kids have their own investment accounts and they're making less than $1,250 in investment income, they have zero tax that they have to pay. If it's between $1,250 and $2,500, it goes to a 10% bracket. And once we get above $2,500 for the kiddies returns, then you're into Form 8615 that includes the parent's rate. Now, if you have multiple children, you know this is a fun form. I hope you're charging well for it because of the time and the expertise that you have to put into it. Now, there is a way of opting out here. There is still Form 8814 where you can just say, we're not going to file it on the kids' returns. We'll apply all of their investment income over to our joint return.
I do.
So just be aware, you do have an opt-out. Parents can just pick it all up if they want to. Now, remember, a child making $13,850 total from all income sources pays zero tax unless there's SE tax involved. Now, again, if they've got a 1099 and they're self-employed, then yes, they're going to get caught with SE tax.
The purpose
But
of this
income
is to keep
tax
people from
doesn't take
pushing
effect
income to
until they
kids.
exceed the 13,850, meaning $1 above that with investment income of $400. So be aware of the fact that if they're bringing in investment income and they have W-2 jobs and they're making less than 13,851, then they pay no income tax. Great situation. All right, relatives. How many of you are probably counting qualified relatives? You might have an older relative that's living in your home. They can earn, now this is earned income, up to $4,700 and still be counted as an other dependent. Once they exceed the 4,700 though, unfortunately, they're back to filing their own return and you cannot count them as dependent. They can continue to stay in your home, but that's all. Superseding returns. If you need a do-over and you filed a return electronically and it's already gone and you're going, oh, I never should have hit that button to transmit it. You now get a superseding return that you can file up to April 15th or whatever the current deadline is. It could be the 17th or the 18th. And it will basically overwrite your original e-filed return. Now, if you'll notice, most programs, at one time you had to mail this in. Now it can actually be e-filed.
So you
to
do
file.
not have to use.
So if you'll notice on a lot of your tax programs, it will say 1040X or superseding return. Well, when you check that box, as long as you're filing before the deadline, it becomes a superseding return and it will overwrite the original filed return. Appropriations Act. Again, student loan payments are still suspended until June of 2023. Remember, we're doing this session in May of 23, so we've still got a little time before students have to start making payments again. Employers can now pay up to $5,250 towards an employee student loan principal and interest. Now, this is going to run through 2025 yet. Now, if you remember, the $5,250 used to apply just for tuition. Now it also applies for student loan debt. So it's got multiple purposes, but the employer must have a written plan making it non-discriminatory that anyone working for the employer that's on full-time status will qualify for this program. The good thing here is it's deductible to the employer and it's tax-free to the employee. It's a win-win, folks. If you have employers looking at trying to come up with good programs to keep their people, this is one. Qualified dividends, long-term capital gains. The figures have grown a little bit. You're looking at the break between the 0% capital gains and the 15% capital gains. You see right now, married filing jointly can make up to $89,250 before they cross over. Single can make over $44,625 before they cross over into the next bracket and start paying capital gains at 15%. All right, everything else is the same. You still have your net tax, your net investment income tax, which is at 3.8%. And you know that your margins here on this or your caps begin at 200 for single, 250 for married filing joint, 125 for married filing separate. And what covers net tax? Capital gains, interest, dividends, annuities, rental income, and royalties are all subject to the 3.8% net investment income tax. All right, funding bill changes. Again, tuition and fees deduction that ended in 2020, but we've seen it resurrected before. It's come back. So for right now, it's off the table, but who knows? It might come back in the future. The $2 million exclusion on cancellation of debt has been reduced to $750,000, and it will run through 2025. So if your house is foreclosed on and they send you a cancellation of debt notice, as long as that debt is less than $750,000, you qualify for the exemption if this was your personal residence. Mortgage insurance premium deductions on itemized. Again, this ended in 2021. Be careful. I know it is so easy because the 1098 form continues to show us this deduction on line 5. Be careful that you don't pick it up if you're itemizing deductions. Right now, it is not deductible. Yes, you could plead ignorance, but in the end, it's coming off your taxpayer's return if they're being audited for their itemized deductions. Medical expense deductible is 7.5%. Again, this runs through 2025. All right, as I said earlier, here's your 2023 new rates if you want to know what they are. 2022 for comparison. You'll find them there in the written material. 2023 child tax credits, it's still at $2,000 per child under the age of 17. You heard me say under the age. What does that mean? The year they turn 17, they lose the deduction. It drops back down to $500. The credit, I should say, drops to $500. Now, the one thing that has changed this year, if you remember, for couples making under 200,000 single, under 400,000 married filing joint, just a few years ago, the cap was 1,400 as a refundable credit. It went up to 1,500 last year, and this year for 2023, the refundable credit is now $1,600. So just be aware that that refundable credit is moving upward. What does refundable mean? It means if you have zero tax, they will still refund up to $1,600 per child that's 16 or younger. How about the new standard mileage rates? They've gone to 65.5 cents on business vehicles, and they've remained the same as the last 6 months on moving and medical. That was at 22 cents, and the charity mileage rate is still at 14 cents a mile. Okay, so let's see what has still around from TCJA, the Tax Cut and Jobs Act of 2017. We still have the American Opportunity Credit. Teachers' expenses are up to $300. They do include COVID gear if teachers are paying for wipes and things to keep their classrooms sanitary. The 179 election is now up to 1.16 million and almost 2.9 million for
So
the base.
you have to put big equipment on
So if you're
depreciation
using the 179
schedule, but then you just write
election
it all off.
expense, be aware that those figures continue to move upward. Qualified charitable donations. Remember, we were talking earlier about seniors over 65 that their standard deduction is $30,700. Well,
We got
if they
nailed
can't
on that
itemize
with
anymore,
Bonneville.
is there something they can do to still write off charitable donations? If they are filing or they're required under RMDs, required minimum distributions, to take a certain amount of their money out from an IRA each year, then they can apply some or all of their RMD to go towards charity. Now, they must be at least 70 and a half years old. And there's a cap of up to $100,000 a year that they can do on qualified charitable donations. Well, Ben, how does this help? Well, it actually reduces the RMD on your 1040 by the amount of the charity donation. Let's give you a quick for instance. What if you had a client that was 72 years old? They're receiving an RMD of $40,000 a year. Well, they're used to giving, let's say, in their life, $20,000 a year to charities. Why not just have the broker reroute $20,000 worth of their RMD onto these different charities that they would give to? What this does in effect, we list the full 40,000, but we show QCD as an exception, and the taxable portion is 40 minus 20, which is $20,000 is all that's going to be shown as taxable income. Well, what did we just do? We just reduced their AGI by 20,000 on something that they would normally do every year anyway. Folks, if you're not taking advantage of this, you're missing out on a great deduction for your clients, especially those that are already stuck with RMDs. If they're 72 or above, they're receiving an RMD and they give generously to charities. This is your answer for a big savings. You want to look at this. It's well worth considering. Don't tuck this away in a file drawer. Highlight this, keep track of it, and see how many of your different clients might qualify for a $7,000 or maybe even an $8,000 savings by using QCDs. That's a big tax break. All right, RMD age. If you were born in 1951 or later, then your RMD age is now 73. Keep this in mind. Business travel meals, they're back to 50% this year. Remember, we can deduct those at 100% for 2020 and 2021 and 2022. Now it's in 2023, we're back to 50% of business and travel meals that are deductible. Enhanced deductions. If you're in the food industry and you have food that's going to be expiring, you can donate that inventory to a charity and you get back 110% of your cost basis on that product that's in inventory. So it's a little premium to give to food banks or to 501c3s that deal with food. Could be a soup kitchen, but it's worth looking into. C corporations are back to deducting just 10% of their adjustable taxable income for charity donations. First year bonus depreciation decreased to 80%. That took effect on January 1st of 2023 and goes through December 31st, 2023. Now, it still covers new or used assets with a life of 20 years or less. But look what happens. In 2024, it drops down to 60%, 2025 to 40, 2026 down to 20% first year bonus depreciation. So be aware that this is coming, it's changing. Your clients are going to be a little disappointed, but you have to be on top of this and continue to keep them informed. Listed property. Again, we know that Vehicles that weigh less than 6,000 pounds
Listed
are considered
means
listed
it could be
property
used
under
business or
section
personal.
280F. Now, we still have first year depreciation, which is
Ask
only at
questions if you
80%
don't
this year
understand some
under
more.
code section 168K. But it's still, we're going to see a slight increase to 20,200 for cars, trucks, and vans for the first year. Second year will max out at 19,500. Third year at 11,700, and all future years at $6,960 for the fourth year on until you tap out everything on the vehicle's basis. Now, if you decide you don't want first year depreciation on a 280F, your 20,200 reduces down to 12,200. Just be aware that that is the new figure for 2023. There is a cap on the 179 election for SUVs, regardless of their weight. They're at $28,900. No, excuse me. We're still at the 6,000 pound limit for SUVs. SUVs less than 6,000 pounds, 28,900 for your 179 election. Now, newer used SUVs or trucks with a 6 foot bed or longer over 6,000 pounds will qualify for the full 80% bonus depreciation figure. Work opportunity credit on Form 8850 has been extended through 2025. That's for new employees, veterans, people that have recently been discharged from prison. They all qualify for this work opportunity credit. New markets credit. This could be the charging stations that you see popping up all over the country. It's extended through 2032, and it does come with a nice credit. We talked about earlier about energy efficient improvements on residence buildings. It's still available on commercial buildings also. So be aware those are still there. And for home builders, not for the purchaser of a new home, but the home builder that adds in all these special energy efficient items do qualify for a credit through 2032. The 30% wind and solar energy we already talked about, that's still in play. All right, under the 529 plan, if you're paying for tuition for your children between kindergarten and the 12th grade, you can take up to $10,000 a year out of the 529 plan and use it towards tuition. If you have a disabled child, that figure jumps to $15,000. How about money earned in a college work learning program? Well, you're going to see a W-2 that now comes through without any income listed on line 1. Nor will you see line 3 or line 5 for FICA tax. The only tax you might see on the student's W-2, if they're going to college and working on campus, is the state income. So when they fill out their W-4, they want to write in the word exempt on line 4C of their W-4 form. They do not want to have tax withheld on something that's not going to be taxable income. Should be a no-brainer, but you never know. You might as well make sure it's right to start with. Form 1023 for exempt organizations. You now can file this online. There is a $600 user fee that's paid at www.pay.gov. Student loan forgiveness due to death or disability is also non-taxable. Foreign earned income exclusion has gone to $120,000 this year, and foreign housing exclusion is up to $16,800 for 2023. Flex spending account deductions for employees has been increased to $3,050, and employer tax-free parking or mass transit passes has now been increased to $300 a month. The estate and gift tax exemption has now been increased to $12.92 million almost up to 13 million per taxpayer, and $17,000 per individual for gifting. You can actually preload for a couple, a married filing joint couple. You can preload a 529 plan with $170,000 from a married couple and not have to report any gift tax form. Now, what does this mean? It means you can't give any gifts to this particular child for the next 4 years. You're preloading for 5 years, and that means not even Christmas or birthday. So be careful with this. It can come back to bite you. Stepped up basis,
Get a
still
1099
there.
for Christmas presents.
AMT for individuals, married filing joint, the threshold's been increased to 126.5, or for single head of household, 81,300. Late submission penalty for submitting a W-2 or a 1099 past the January 31st deadline could cost your taxpayer some serious money. $50 per return for the first 30 days goes to $100 per return beyond 30 days after January 31st. Federal poverty level, we were talking about that earlier for 2023. For an individual, $13,590. For a family of 4, $27,750. You heard us talking about the 400% top off. For an individual, that 400% top off would be $54,360. For a family of 4, $111,000. Now, the annual long-term care premium maxes out. You see the chart here. I'm not going to go through it with you. Part of the reason I mentioned this, your program would automatically cut back on anybody that was overpaying and limit the amount. But the reason I'm listing it here is to let you know that if you have someone that is self-employed filing on a form or a Schedule C or a Schedule F, they would qualify to deduct this as a self-employed health insurance premium at 100%, nevertheless. So, that being said, don't forget if they're over 65 or they're paying Medicare premiums, those would also be deductible as a self-employed health insurance premium. In addition to policies that they're paying for outside of an employer's plan. In other words, if you work as a self-employed, your spouse is working for an employer, your spouse gets health insurance coverage through the employer, you cannot write off those premiums. But anything you're paying directly to the insurance company, COBRA insurance, long-term care, Medicare premiums, they all would be deductible as a self-employed health insurance deduction.
No,
Now, there is a cap here. It will cap out at whatever the
They
net
said they recorded this in
self-employed
May
earnings are.
2023.
So if you only are showing
But we're not controlling it.
$8,000
Oh, we
in
started
net
it.
Schedule C
Okay.
income,
Yeah. It was
your health
$32.
insurance
It was
premiums
pretty
will
good.
cap out at $8,000
And
in this
had to get
particular
through
example.
several screens and then it started.
Yeah.
FBAR return or Form 114 through FinCEN. Okay, if you have filed a Form 4868, your FBAR return is automatically extended to October 15th of that tax year. So, but if not, remember, these don't end at the end of June anymore. The deduction, the FBAR deadline is now whatever your 1040 deadline is. And your 4868 will extend it for you if it's been filed. The threshold on the 1099K has been reduced, as everyone knows, from 20,000 down to 600. And you might want to think about this. If you get one, for $600 from, say, Venmo. And it was just money going back and forth between family or friends, paying for dinner or other things. You probably want to list it on Schedule C on line 1, and on line 2, show it as money shared between family members or friends on line 2 and exempt it out. Why am I suggesting this? Well, how many of you get these CP 2000 letters that come in a couple of years later? You could be avoiding it by listing it on Schedule C, listing it on line 1, writing it off on line 2, coming back to 0.
So
It offsets
that's a
the little
1099
trigger that
that we're
picks
gonna
up on the
get
CP 2000 letter.
for
So-
all the money that, what?
Now,
People pay
state
us
relief
through credit
payments
cards,
Mhm.
both accounts.
for those that are itemizing and are under $10,000 in SALT. SALT is state and local taxes on your itemized deduction sheet. The non-taxable states are listed here. I'm not going to go through them with you, but remember, if your SALT figure is above the $10,000 cap and you don't get to take advantage of it in the previous year's itemized deduction, then your refund could actually wind up fitting into that amount and it would exempt itself out. In other words, if you're not getting a tax benefit for state income taxes paid, then you won't be held responsible for counting this as taxable income. All right, ready to jump into something new. We're on the Secure 2.0 tax update. Now, this was passed in 2022, but most of it did not take effect until this year. So be aware of the fact that this is going to impact a lot of your clients that are receiving RMDs, but it may actually impact people beyond that. So now, normally you must cash out any money and actually take an RMD for the first 10 years after someone's passed away, if you've inherited their Roth account, their IRA account, or their employee retirement plan. It's usually spread out on RMDs. However, even though it's suggesting that the Roth be split, if there's a way that you can, no, I guess I better stay with that. Let's just stay with the rules. That way I don't get myself in trouble and I'm not taking you down a pathway that you might get questioned on later on. So let's stay with the RMDs on these amounts for 10 years. There is a group that will be exempted here. This could be spouse of the deceased owner.
Wrong.
They can move, if it's an IRA, they
You
can move
inherited
that
an
money over
IRA.
to their own IRA.
You have 10 years. but you
Also,
can take it
a
all out in
child
9
under the
years.
age of 18 of the
It says
deceased
keep that
would
readable.
qualify for this exemption
He's
under the
absolutely
10-year plan. Also, a permanently disabled or chronically ill individual that was a beneficiary of the deceased, they would qualify for an exemption. And someone that's within 10 years of the age of the deceased owner. Well, who might this include? Well, it could be siblings of the deceased. Or if stepchildren are involved, it could even include stepchildren in a second or third marriage, in a later marriage. So be aware that there might be an exception here that would apply. Now, let's talk about the relevant changes in the Secure 2.0. If you're born in 1951 or later, there are no RMDs for you until you reach age 73. If you were born in the year 1959, I'll get this correct. If you were born in the year 1959, no RMDs will take place until you reach the age of 75. So these are a nice change on RMDs. Now, the $1,000 catch up on IRAs that we've seen up to
That's
this
goofy.
point
Now we're not gonna
now
know
will
one
be
year.
allowed to adjust for
There's
inflation.
more than 1 year.
So
to
this $1,000
start it.
figure
Damn.
going forward will be moving upward according to the cost of living index. Also, the 50% RMD penalty, which has been out there, now drops to 25%. And if you fit one of the special stipulations, it could go down as low as 10%. You'll see these special stipulations,
Ask the IRS, say the
situations.
client's goofy.
You will see these special
And
situations
they'll waive it.
listed on some of the drop-down screens or in the regulations if you pull up the publication. Public safety officers, we've known that they could qualify for tax exempt or tax or penalty-free money at the age of 50, but now they've added a second caveat to that. If they've got at least 25 years of service, they could also qualify at an age less than 50. So if they started working as a public safety officer at the age of 20 and they have 25 years of service, in this particular example, they could get out at age 45 and have no penalty apply towards their public safety retirement. The $5,000 IRA withdrawal on having or adopting a baby can now be repaid over a 3-year period, making it non-taxable. So be aware that's an additional change under the Secure 2.0 Act. Okay, here are some of the additional items. Conservation easements are now capped at 250% of the taxpayer's basis. Now, some of you might go back to 2016 and say, Ben, I thought in 2016 there was something out about this $250,000 cap. Well, there actually was, but it was by presidential fiat. And that was offset. Now Congress has come back this many years later, and they've reinstated the 250,000%, 250%, not 1,000, Ben. Congress has come back and now put a 250% cap on the taxpayer's basis. So if they pay $10,000 into a conservation easement, they can write off up to $25,000 on Schedule A under charitable donations. You do have to use Form 8283, and you want to use the drop-down box that allows you to deduct more than your basis. All right, student loan payments. They now qualify under an employer matching retirement contribution. So if instead of putting money into your retirement contribution, you pay down your student loans, your employer can now use that for their matching percentage, which could be up to 3% of what you've paid into your student loan. Interesting. Some things that are changing for 2024. You'll be able to roll over a 529 plan into a Roth IRA. Now you notice the little asterisk up here. There are all kinds of special conditions that will apply, but just be aware that if you've got children that are reaching the age of 30 and still have money in their 529, the money has not been used. Instead of being taxed on it, you might have an option of rolling it over to a Roth IRA. That doesn't start until 2024, though. Also in 2024, there will be added exceptions to the 55329 penalties. So you have a list of 12 right now. That number is going to increase, but it doesn't happen until 2024. In 2025, the retirement savers credit will be extended. Right now, that's set to expire in 25. It will be extended and changed slightly. You're going to see some slight changes in 2025 to the retirement savers credit. Also in 2025, the government database will be set up listing lost and found taxpayer retirement accounts. So this should make it easier. If you have loved ones that have passed away, if you have a loved one that no longer remembers what retirement accounts they qualify
This is
for or where
federal.
they have them,
This is in addition to
there will be a government
California's
database to
sheet
help
with
you
the
out in
controller.
2025. All right, 2106. It is still alive if you fit into one of these four groups. So let's talk about the four groups. A fee-based official. This is usually someone that works for the state or local government. Maybe they serve summons or police warrants on a fee basis. They're paid on a W-2, and any expenses for their mileage, for a portion of their cell phone, for possibly even an office in the home, depending on how much of their preparatory work they do on mapping out where they're going to go the coming day to deliver summons or warrants. You could find a lot of expenses that might qualify on the 2106 for a state or
That's
local
what she got
government
nailed on.
fee-based official.
But the definition of
second
what the hell is a
category,
fee-based?
Qualified performing artists. Now, these have not been updated. This one hasn't anyway, since the 1960s. You notice that the AGI cannot exceed $16,000 annually before deducting expenses.
What?
So your qualified performing artists are going to be a very small group making $16,000 or less. Armed Forces reservists, people with the National Guard or with a reserve unit who have to travel for training or service commitments. If they're traveling 100 miles or more from home and they're staying overnight. I know these sound familiar, don't they? You can deduct the transportation, lodging, and up to 50% of the meal per diem if they're not provided with lodging or provided with meals where they're attending their training or their service commitment. This does not give you the authority, however, to start deducting maintenance on their uniforms and other related expenses. That was all on Schedule A. It is gone until 2026. We'll see if it returns. Finally, the final group is disabled employees. Now this one, the other three are listed on the front of the 1040. You check a box on the 2106, it takes that deduction without any 2% deductible. You heard me correct. There's no 2% deductible on this 2106, and it takes it directly to the 1040 and allows it to be written off above the line. All right. The disabled employees actually goes back to Schedule A. Now you're saying, Ben, I thought we didn't have that as a deduction anymore. Well, it's a drop-down screen. If you remember, if you have taxpayers that get a W-2G for gambling, there's a place where a pop-down or a drop-down screen that allows them to deduct their gambling losses. This is listed on that same drop-down screen. If you have a disabled person that's having to pay for special equipment in order to work for a job, and the employer's not paying for it, the employee has to pay for it, this is where they get to write it off. On the 2106, there is a checkbox that allows you to take this. And again, there is not a 2% deductible on this, so you don't have to worry. But if they can't file a Schedule A normally, then really they don't get any benefit out of this. Statutory employees, you see the guideline here, 3121D3. And again, there's a special group of 4 that show up on this. And that group starts with truck drivers, but local truck drivers that distribute beverages, meat, vegetables, fruit, bakery products,
So they got
or
a W
laundry
two.
and dry cleaning. Now, for
Put them
some
on
reason,
Schedule
milk
C.
delivery is excluded from
I
that
think
group.
expenses.
But if they're paid
It's weird.
as
Usually
agent
I've only
on
seen
commission,
life insurance sales.
they would qualify as a statutory employee. Now, Ben, what if the employer will not check the box statutory employee? Well, unfortunately, it's up to us to try to convince that employer that their employee here does qualify for this special deduction. Well, Ben, what are you talking about? You can see that even though this taxpayer is paid on a W-2, they get to write off their unreimbursed business expenses on Schedule C. Wow, is this a great deal? Absolutely.
What is
Now,
this?
Your truck
Homework.
driver may actually be driving a company truck, so they're probably not going to get much more than their phone. I don't know if you'll be able to justify home office. There's a lot that's on the line here, but maybe if they have to wear a uniform, you can get the cleaning on their uniform, but it's not going to be much anyway. So let's look at the next bullet down here on the bottom of the screen. Full-time life insurance agents that sell insurance or annuities primarily for one employer. Now, this is the place that most commonly you'll find this. You'll see statutory employee checked on line 13, and this allows that insurance agent to write off maybe business use of their cell phone, mileage to go call on clients that they've kept contemporaneous records on. You might also see a situation where they're taking office in the home. They would have a good chance at writing off some good deductions. Third group is individuals that work from home using the employer's material and goods. It's sort of like a piece goods production. Let's say you have someone that does monogramming for a dry cleaner, and the dry cleaner provides them with the customer's blazer or jacket or other things that need to have something embroidered on it. Initials, company name, something. And all the supplies and materials are provided by the employer, but the employee works from home to do it. Well, they could take business use of the home. That would not be a problem. However, you'd have to have this employer check line 13 on the W-2 that they are a statutory employee. And this is where you might come in to try to show them what the regulations say. Now, the only expense to this employer is going to be for an additional W-3 form at the end of the year. Everything else is handled the same on payroll. There'll be a different W-3 because you can't put ordinary employees and statutory employees on the same W-3 form. So the last group is full-time traveling or city salespeople. Wow. This does cover just about everything on salespeople. And they're filling orders from wholesalers, retailers, contractors, and hotel, restaurant, and similar establishment operations. Wow, that's going to cover a lot. The item can be either for resale or for the business's operating use. Not bad, but here's the catch. It must be tangible merchandise. It can't be for services. It can't be for computer services, accounting services. It has to be a tangible item that they're selling. It's got to be some kind of a widget, as we used to use the word, in order to qualify. If it's for services, it does not qualify. So if you have somebody selling let's say toilet paper, and they're selling it to hotels and to restaurants, and they're selling it to similar establishments, retail stores. It could be almost anything, but it's got to be a tangible item. Then they could qualify for statutory employee status. Quick example is I had a taxpayer that sold medical supplies for a medical supply house. And when the TCJA came in 2000, late 2017, from 2018 on, we could no longer write off all the expenses, the meals out, all the things that were deductible. This taxpayer had about $16,000 worth of expenses disappear in 2018. Very upsetting. And so for the following year, I said, we're not going to let this happen again. We're going to talk to your employer and we're going to have you listed as a statutory employee. Well, the employer came around to this point of view, and when I showed all the regs on it and the requirements, and the employer agreed to check statutory employee, now that employee gets not only the 16,000 they had, but the 2% deductible is gone. So he gets all these expenses on Schedule C and is very happy for the time I spent in trying to help him get statutory employee status. Now remember, since FICA tax is already withheld, there is no SE tax. Even though the expenses are listed on Schedule C, there is no SE tax to pick up on. Okay, let's look at medical deductions for caregivers. And these are listed as anyone that can no longer perform two of the activities of daily living, or ADLs. So you see on the third bullet here, there's 6 activities listed. They have to be able to feed themselves, not especially prepare the food, but be able to feed themselves. They have to be able to practice personal hygiene.
That service.
In other words, they brush their hair, brush their teeth, shave.
Well, that's good.
Transference. They can transfer from one place to another, from the bed to the bathroom, back to the bed. They can go from the kitchen to the easy chair or to the couch
It
and get
adds
back
up
up.
their
They
medical
don't need
expenses.
assistance
They can't.
in transferring from one location to another. Bathing. They know how to bathe and they can bathe themselves. Dressing. They can dress themselves. And finally, continence. So you have these 6 activities of daily living. If a doctor will write a letter saying that they can no longer perform at least 2 of these 6, then your taxpayer qualifies for standby unlicensed care, and it is fully deductible. Now remember, there is a 7.5% deductible on the AGI, but that does still mean there's a lot of money that you're going to probably spend for care.
1 year.
In fact, the average caregiver
Care.
gets paid somewhere north of $70,000 a year if they're there the majority of the time. They do get paid during their sleep hours too, yes, because they sleep on location with the person needing the care. Now, that's not all the situations. There's places where the family will cover the evening hours and the caregiver will cover the daylight hours when they're at work. But it's still a large deduction. However, it does require the doctor's letter and diagnosis to make it work. W-2s are required in that case, so you're going to have to be picking up payroll. However, you can use a Schedule H to pay the payroll taxes with the 1040 at the end of the year. because this is domestic employee. Medicare premiums, just a quick breakdown. You can see that's up to 194. You'll pay the lowest Medicare premiums if married filing jointly at 194,000 or less in AGI, 97,000 or less for single. You can get an idea on the chart for the materials I've provided you, where all this comes in. Remember, it's impacts 2 years later. So the AGI from 2021 is now impacting the 2023 Medicare premiums. Be leery if you got a taxpayer that wants to go out and not borrow, but take a large distribution out of their IRA or retirement account. This could really have a dramatic effect 2 years later on the Medicare premiums for this taxpayer. So make sure they understand. You can pull money out of a Roth, you can pull money out of your investment income, but be very careful about pulling extra money out of a retirement plan. It does come with some severe consequences. Installment agreements. We're not going to spend any time. Just be aware that there is a charge for an installment agreement with the IRS.
That is where you pay your tax every month
2023
instead of.
Social Security wage base maximum is now up to 160,200. In 2024, it goes to 167,700. Medicare premiums are still at 1.45%, but if you fall into that net income tax threshold from the Affordable Care Act, once you go above 200,000 for single and 250,000 for married, your Medicare premium will be increased by 0.9%. So be aware that that's an addition, and that shows up on an addition form on the 1040. FICA taxes for domestic employees. We were just talking about caregivers, which would be a domestic employee, now up to 2,600. In other words, until they reach 2,600, they're not really required to file a Schedule H or pick up tax on them. The W-2 could still apply, but the Schedule H, it's voluntary at that point, up to 2,600. HSA, the maximum contribution for 2023 is $3,850 for self only and $7,750 for family coverage. Now remember, if your taxpayer is 55 or older, they can add an extra $1,000 to that. And if you have two taxpayers, both under an HSA, both showing self-only coverage, and they're both 55 or older, they can each get an extra $1,000. Well, Ben, what does that mean? Well, instead of someone over 55 with family coverage getting now $8,750 they can contribute to their HSA, by having two single coverages together, that can go to $9,750. So, little strategy there.
Savings account,
If
like an
you have
IRA,
both
they
of
put
them
money in,
eligible
get a
for an
deduction for
HSA.
medical. If
Remember,
you
once
take it out
they
and use
reach
it for
the age of
medical, it's not that.
65, the law
It's
prohibits
a
them
nuisance.
from putting any further money into the HSA. They can be penalized
If
or
they
fined for doing that. So
Take a deduction
make
going
sure
in
they
and
understand
take
the
the
day
money
they
out
turn
without medical.
65, they
the
turn
penalty.
off their HSA contributions. These are the limits. I'm not going to spend a lot of time here. You do have a high deductible plan with an HSA. That's why you have limits. I'll go back and just identify that very quickly. This is the minimum and the maximum deductibles for a high deductible health plan, which is something, it's like a major medical plan that you must have with an HSA. Okay, adoption credit has gone to $15,950. Be aware that there are AGI thresholds for that run between $239, $230 and $40,000 higher. So you saw me mention this earlier. If you want to draw $5,000 out of your IRA because you're adopting or having a baby, you can do so without penalty. You notice it's not without tax. It's just without penalty. But now, in addition to this, as we mentioned earlier, you now have under this new law that you can pay that $5,000 back over 3 years if you choose to. So just be aware of the fact that that does now come with a payback option if you don't want to pay tax on it in the year it's withdrawn. Retirement savers credit or savings plan limits, I should say. Excuse me, I'm jumping ahead of myself. 2023 retirement savings plan limits. So let's see what we've got here. If you're looking at a 401k, 457 or 403b, the new limit is 22,500 for those under 50. And if you're over 50, you can add up to 7,500, taking you up to a total of $30,000 that you can put into your qualified retirement plan with your
Spike Hill did a
employer
better job
under a
of
401k,
explaining this
457,
stuff.
53B. Now, simple IRA is up to 15,500 with a catch-up provision for those over 50 of 3,500. IRAs, Roth IRAs are at 6,500 now with $1,000 catch-up provision for those over age 50. And you do have income thresholds that get into this. So be aware of all these different thresholds. I'm not going to go through them with you. You can read them. But the max SEP contribution for 2023 is now up to 66,000. And the retirement savings credit or savers credit now phases out at 73,000 for married filing jointly, 54,750 for head of household, and 36,500 for single. Estate and gift tax exemptions now go to 12,920,000. And remember, portability is also in play here. So if you have one taxpayer that only has $1 million in assets and they pass away, the surviving spouse can file a Form 706 and take the remaining 11,920,000, add them to the estate and gift tax
You
exemption
did
they
that for
have.
how?
Now, why would you do this, Ben? I got clients that are not going to have anything close to 25, $26 million when they die. Okay, but what's going to happen in 2026 when the TCJA expires or sunsets? Well, what's going to happen is the amount goes back to 5 million. Yes, it will be adjusted for cost of living, but I'm going to just throw it out at 5 million right now. So if you have a taxpayer that's got 2 or 3 million already, do you know how long they're going to live? What if they live 20 years more and that 3 million increases to 10 million? Well, if they didn't take advantage of the portability, which does not get impacted, by the way, that total stays the same regardless of where the new total goes in 2026, then you might wind up with some mad survivors that decide to come after you for not taking advantage of portability. Now, Form 706 does have a special provision, and I think I've got it on the next screen here, that you can go up to 5 years before you file the 706 if you list on the top of it Rev Prop 2022-32. Gives you a 5-year extension to file the 706 for DSUE or portability, same thing, on the surviving spouse, taking any remaining unused estate tax credits over to the surviving spouse. Here's where the code section is that helps cover you for that. Now, an 8971 needs to be filed within 30 days of the 706 to identify the values of the properties that are being transferred over to your surviving spouse or the beneficiaries. Why? Because after 3 years, if IRS doesn't challenge these values, then they no longer have the right to. statute of limitation drops after 3 years. The values on the 8971 stay, even though these beneficiaries might not sell the property till years later. Okay, trusts. Well, as we can see, the trusts after $14,451 increased to 37% tax. The rate jumps to 37%, and also they would be stuck with a 20% long-term capital gains rate and get stuck with a 3.8%
Plus,
net investment.
and the
income
states
tax.
have the worst tax bracket.
So if you can move some of the
Bill Clinton put it
money
in effect. They don't
from
vote.
the estate or the trust into the
So we
beneficiaries.
always try to
into the
push it
lower
out to
bracket,
the beneficiary on
keeps
day
the
one.
trust or the estate from paying such a high tax rate. All right, gifting between spouses is unlimited. However, if you have a non-citizen spouse, that capped out or does cap out at $175,000. Benefits, there are all kinds of benefits to unlimited gifting.
Excuse me.
Biggest being stepped up basis if you move assets over to one that might be terminally ill and they have those assets in their name for at least a year and a day, then when they pass away from their terminal illness, all those assets come back with a stepped up basis. All right. As we said earlier, 17,000 is the new cap to individuals. So you have all kinds of potential scenarios for grandchildren, grandparents giving together to multiple grandchildren. There could be some nice scenarios to move some of the money if that's an issue you're worried about. All right, 2023 educational credits and deductions, they have not changed, but the income thresholds are higher. So AOC or American Opportunity Credit is still at 2,500, 40% refundable credit. And you can see your amounts here, how they change. Now, there is one special provision. If you have a student who is getting a full ride and the scholarship money covers their tuition and it balances it out, if any of that scholarship or grant money is allowed to be used for room and board, here's a scenario that might be helpful to you. You could reduce that grant by $4,000, which would max out the 2,500 American Opportunity Credit, and apply it to the students 1040 as grant income on line 8Z of Schedule 1. What am I suggesting? Well, if the student will count part of that grant income, or at least $4,000 of that grant income, as taxable income for themselves, and if that's their only income, they're not going to owe tax anyway. Remember, they have a threshold of over 13,000 these days in income before they have any tax. Then the parents could still qualify for the $2,500 American Opportunity Credit. However, you're going to need to probably attach Form 8275 and list this regulation and what you did. Why? Because the 8275 is going to tell IRS, you're in the right, you did your research and your homework, you figured out a way how to reduce the grant or scholarship money by $4,000, taxed it against the student, and opened up the $2,500 credit again for the parents. So be aware, this is something that is there. It's under Regulation 1.25A-5C, and it does allow this to happen. So if you're not utilizing this on Form 8863, and you have the opportunity, you got to get everybody on board, but it can be done, and you can add an extra $2,500 if they're not above the 160 or 180 threshold. Now, if you got taxpayers that are above $180,000 married filing joint, they will not qualify anyway, so it doesn't matter. But if you got some that are under 160, you can put another 2,500 in their pocket if you utilize the right strategy. Okay. Lifetime learning credit, $2,000. That's 20% of tuition and fees. So after you hit 10,000 in tuition and fees, it is gone. You have your income threshold, it's the same. Just be aware of the fact that that's still available. Student loan interest at 2,500. Your phase out is 155 to 185 for married, 75 to 90 for single. And EE savings bonds, I'm not going to spend a lot of time here because I want to make sure I get to some other categories, but the information's right here for you. Federally declared disasters. Now again, these normally get reported on Form 4684. No itemizing is required if it's considered an FDD under FEMA. You can go on the FEMA website and find that particular disaster. It's given a special number. You need to write down that number because that number is going to need to be listed on the 4684. Otherwise, they're going to kick the form back to you and tell you to see the FEMA number. So the 4684, again, no longer applies to thefts or non-declared disasters. It's only for federally declared disasters. And it can be claimed in either 22, going back and amending the 22 return, or the 23 return. You have some flexibility if you need the money right now. Net losses of 20,000 or less can be solved very quickly with 2 repair estimates, and you choose the lower one. Publication 547 helps clarify more on this. And if you need to, with FDD questions, you can dial up this number 866-562-5227.
We used to deduct personal casualty and
Federally
thefts,
declared disaster.
and they don't allow it anymore. Only businesses can.
Now, if you remember back during 2020, you could take out up to $100,000 of your IRA and spread the payments over 3 years. You used Form 8915. That's still, the concept is still there, but the amount has been reduced from $100,000 to $22,000 that can be withdrawn. If you're in a federally declared disaster, you can take up to $22,000 out of your IRA and using Form 8915F, spread the payments over 3 years, the tax over 3 years. Now, you can still borrow. Now, you notice there's a difference between withdraw and borrow. You can still borrow up to $100,000 from an employer retirement plan and pay it back over a 6-year period. Well, Ben, I thought it was 5 years. Normally it is, but for a federally declared disaster, they throw in an extra year for the employer. So it can be paid back over 6 years.
Hey, there's
Now,
no
if you have
attendance questions
employees
to
that work
answer.
for you in an FDD and you continue, you've had to suspend operations, but you're still paying your employees or workers, you could qualify for a 40% credit up to $6,000 an employee. Be aware that's still there. Okay, identity theft protection measures. Again, these days, most tax programs require a driver's license or the information off of it. And you'll notice on W-2s, many of the employee social security numbers have been reduced to the last 4 numbers. You do have an 800 number if you need to order a transcript. You can give that group a call rather than going through 829-1040, which does have a long wait to it. IRS has come out with a new letter that if you've changed addresses and you seem to be out of cycle for requesting a refund, or you're requesting a larger than normal refund than you would normally receive, they will send a letter not only to that new address, but also to your old address and ask you to confirm you're actually filing at this new address for a larger refund amount. Why are they doing this? It's to try to catch the scammers and the people trying to steal your identity. It's really a good thing. It requires you to respond quickly, usually by fax. You can respond by mail or by phone, but faxing is the quickest way to get this to them. Tell your taxpayers it's not a scam. If they're sending you a letter saying we have a tax return filed on your behalf requesting a refund for $18,275, then if your taxpayer hasn't filed yet, they need to respond to the IRS. It is legit. Pub 78. Now, Pub 78 identifies all 501c3 organizations. So if you've got a 501c4 through 501c29, they are exempt organizations, but donations to them are not tax deductible. So be aware, Pub 78 will help identify by EIN number whether that organization is exempt or not. Charity donations. Okay. So for people that want to still itemize, maybe if they're giving a lot of charity money, you could do bunching, which means maybe once every 3 years, you give a large donation, 3-year donation to all your charities, and then the next 2 years they get nothing. But there's a better idea than that. Look at the second bullet. A donor advised fund. And almost all stockbrokers have them. Fidelity has them. Schwab has them. Morgan Stanley, Merrill Lynch, all of the major brokers have donor advised funds. It allows you to put in a large amount, let's say $25,000, and then it allows you to authorize the distribution of that money online
The definition
to all the
of fees
different
was wrong.
charity organizations. And if you want to leave that money in there for 3 years, that's fine. So the charities never even realize that you're not contributing to them on a regular basis. But in fact, it's actually allowing you the flexibility to put in the deduction one time every 3 years or so, and then distribute the money. You get the donation in the year of the contribution to the donor advised fund, but then you distribute the money, like I said, online. You go into the organization's website, you have a special sign in, and you take care of distributing that money to the charities. Now, another strategy is a 181 film credit. I'm not going to spend a lot of time here on that, but it's something you might want to look up. And real quickly now, you can now do, with your CAF number, you can now do 2848s, which is power of attorney, or 8821s online if you're approved with the electronic signature. And you can actually enter in the 2848 online.
Power of
Your
attorney.
taxpayer's going to have an ID number with the IRS also, but it can all be done electronically on the irs.gov website, or the electronic website, I should say. And you don't have to submit paper anymore through fax. That being said, I hope you enjoyed today's session. And I want to wish you thank you. And until the next time, this is Ben Tallman signing off.